Hello friends, hi, very good morning to all of you. In the last few sessions, we discussed many important chapters. Process costing we discussed, joint byproduct we discussed, standard costing we discussed, service sector costing, operating costing we discussed. Now today, we are starting with one of the most important chapter from examination point of view, just like standard costing, another chapter, marginal costing. Now, in every paper, you will find the sum of marginal costing. So from examination point of view, it's very, very important. I'll be addressing all your queries, guys. So don't worry. I'll be discussing each and every part one by one. So be patient. And at the end, whatever the part which is left out, we'll be discussing in the session tomorrow. So please focus what I'm teaching you guys. So let's start. Now, this technique, marginal costing, what is the utility of marginal costing? What is the need of marginal costing? What is marginal costing basically? Now, this is a costing technique wherein whatever the variable cost is, it is only charged to the product. Now, about fixed cost, it is simply set off or wiped off against contribution. I repeat again, in this method of costing, whatever the variable cost is, in this method of costing, whatever the variable cost is, that is basically charged to the cost of the product. And as far as fixed cost is concerned, it is completely wiped off against contribution. So now, this is what marginal costing is. Now, what is the need of marginal costing? Very important. It's a part of management accounting. It assists management in decision making. If management wants to take decision, they will refer marginal costing technique. So now, how these management people take decisions, that we will be discussing in this chapter. So there are many points covered in this chapter. So I'll be discussing each and every point one by one. So let's focus. Let's start. Before starting with marginal costing, I would like to discuss few important concepts. Now, what is marginal cost? The cost of producing additional unit. Let's say, suppose I've produced 10 units and the cost is, say I've produced 100 and the cost is 1000. Now suppose if I produce 101 unit, the cost is say 1010. Now here rupees 10 is what? The marginal cost. That is the cost of producing one additional unit. Let's take another example. Say suppose I am producing 100 units and the cost is 1000. For producing 101 units, the cost is say 1050. So herein, the cost of producing one additional unit, that is rupees 50, is basically what? The marginal. I hope this part is clear. I repeat again, what is marginal cost? The cost of producing one additional unit. The cost of producing additional unit is basically marginal cost. I suggest you guys to please copy this part. Now another important concept is variable cost. What is variable cost? The cost that changes according to production. I repeat again, what is variable cost? The cost that varies according to production. The cost that varies according to production. Let's say, suppose I am producing 10 units and the cost is say rupees 100. If I am producing 20 units, then the cost will be 200. If I'm producing 5,000 units, the cost will be 3,000. If I'm producing 1 lakh unit, the cost will be 10 lakh. And if I'm not producing any units, no cost will be incurred. So what is variable cost? The cost that varies according to production. As and when the production is increased, the cost will also increase. As and when the production is decreased, the cost will also decrease. And if there is no production, no cost, no variable cost. Now, what are the examples of variable cost? Very simple. Raw material. The best example of variable cost. What is covered in variable cost? Raw material. Let's say I am the manufacturer of this pen. I repeat again. Let's say I am the manufacturer of this pen. Now, what is the raw material used in manufacturing this pen? Plastic and ink. Now, if you want to produce more number of pen, more the plastic and more the ink will be required. If you want to produce lesser number of pen, less the plastic, less the ink will be required. And if you don't want to produce any pen, no plastic, no ink will be required. Now, another example of raw material. Say I am the manufacturer of this shirt. Suppose 2 meters is to be used for producing one shirt. Suppose if I am producing 10 shirts, 20 meters will be required. If I am producing 100 shirts, 200 meters will be required. So what is basically the fabric? What is basically the fabric? The raw material in manufacturing the shirt. So raw material is a very good example of variable cost. Another example of variable cost is labor. Labor is another good example of variable cost. So suppose I am the manufacturer of this shirt. Now, I employ my labor like that. They will be paid rupees 20 per shirt as stitching. So now, if I want to get more number of shirts stitched, I have to pay more amount to the labor. If I want to get less number of shirts stitched, I have to pay lesser amount. If I don't want to get my shirt stitched, no cost is to be paid to the labor. Now, apart from material and labor, there are many expenses incurred known as overhead, of which all the variable overheads will form part of variable cost. Say power, coal, fuel. So all will form part of variable cost. So I repeat again, what is variable cost? The cost that varies according to production. As and when the production is increasing, the cost will also increase. As and when the production is decreasing, the cost will decrease proportionately. And if no production, no variable cost. I suggest you guys to please copy this part. Now, another concept I am discussing is fixed cost. What is fixed cost? The cost that remain fixed irrespective of production. I repeat again, what is fixed cost? The cost that remain fixed irrespective of production. Suppose that I am producing 10 units and the cost is say 1 lakh. If I am producing 5,000 units also, the cost will remain same 1 lakh. If I am producing 10,000 units also, the cost will remain same 1 lakh. If I'm not producing anything also, again the cost will remain 1 lakh. So, what is fixed cost? The cost that remain fixed irrespective of production. Whatever the number of units you produce, this cost will always remain fixed irrespective of the number of units produced. Now, what are the examples of fixed cost? Best example, rent. Let's say, suppose I took a factory for manufacturing, say, these pens only. Now, the rent per month is say 1 lakh rupees. Annual rent is 12 lakh rupees. Now, whether I manufacture 1 pen, 10 pen, 20 pen, 1 lakh pen, or even if I call my friends and play cricket, boss, I have to pay rent of 12 lakh, irrespective of the numbers of pens manufactured. What it is? That's fixed. Salaries, insurance premium, etc. So what is fixed cost? The cost that remain fixed irrespective of production. Whatever the number of units you produce, this cost will always remain fixed. Now, let's study a scenario. Many companies has to shut down their business. Why? My question is, many companies has to shut down their business. The question is why? The only reason is that they are not being able to recover their fixed cost. Because most of the companies who has to shut their business, the part which is responsible is the fixed cost. Because anyways they are going to incur the fixed cost. As far as variable cost is incurred, as far as variable cost is concerned, it is incurred only when there is some or other sort of production. But fixed cost is anyway these companies are going to incur. So many companies have to shut down their operation. Only the reason is that is the fixed cost. Suppose say I took a premise on rent for manufacturing these dusters. Now there is no business, the business is down. Still I have to pay rent to my landlord. So I'll survive for say 1 month, 2 months. But if there is no business at the end of the 2 months or 3 months or 4 months, whatever it is, if there is no business, I have to shut down my business because I am not being able to recover my fixed cost, that is the rent. So many companies has to shut down their operation. So the major headache for each and every company is that how to manage the fixed cost. Let's take a very simple example. Suppose this manufacturer, I am manufacturing this pen. Now, this pen is manufactured at a variable cost of rupees 8. Again, this pen is manufactured at a variable cost of rupees 8. And this pen is sold for rupees 10. Now, how much we recover per pen? Rupees 2. Very simple. Again, I repeat, this pen is manufactured at a variable cost of rupees 8 and it is sold for rupees 10. Now, how much we recover this per pen? Rupees 2. Now, after getting rupees 2 per pen, what will be in my mind? That at least I should sell that much of pens that I am able to recover my fixed cost. I repeat again, the variable cost of manufacturing this pen is rupees 8. The selling price is rupees 10. Now, I am recovering per pen rupees 2. The net recovery per pen is rupees 2. Now, what will be in my mind? That at least to sell that much of pen, that I should be able to recover my fixed cost. Let's say my fixed cost is what? 1 lakh. Now, what will be in my mind? That at least I should sell that much of pen, that at least I should be able to recover my fixed cost. Now, per pen I am getting rupees what? 2. So, if I sell 50,000 pens, if I manufacture and sell 50,000 Once I recover 50,000, I'm safe, I'm relaxed. In this chapter's language, we can say it is break-even sales. That is the sales where I'm neither incurring any loss or nor getting any profit. Anyways, you guys please copy this part. Okay. हाँ सर अभी आ रहा है. हाँ वो साइलेंट पे था सर. Sorry, there were some network issues, so I'm repeating again whatever the part I have discussed. I've discussed fixed cost. What is fixed cost? The cost that remain fixed irrespective of production. Whatever the number of units you produce, this cost will never change. Say I am manufacturing 10 units, the cost is 1 lakh. Now if I manufacture 5,000 units also, the cost will remain same 1 lakh. If I manufacture 10,000 units also, the cost will remain same 1 lakh. And if I don't manufacture any units, again the cost will remain same 1 lakh. The example of fixed cost are rent, salaries, insurance premium, etc. I suppose if I take, if I suppose took a factory on lease for manufacturing the pen, I'm repeating the same part what I have discussed. So suppose say I took a factory on rent for manufacturing these pens. Now suppose the rent paid is say 1 lakh rupees. I repeat again, the rent paid is say rupees 1 lakh per month. So the annual rent will be how much? Rupees 12 lakh. Now suppose in the factory, if I manufacture 1 pen, 10 pen, 1 lakh pen, 10 lakh pen, or if I call my friends to play cricket in the factory, boss, I have to anyways pay the rent of rupees 12 lakh. So we can say rent is the best example of fixed cost. Another example, salaries, insurance premium, etc. Now I explained this concept. Now every company has the major headache. Every company headache is to what? To recover their fixed cost. The most of the companies has to shut down their business or operations because they are not being able to recover their fixed cost. Now let's say, suppose if I started a business for manufacturing of dusters, the rent of the factory is say rupees 1 lakh. Now say due to lockdown or due to coronavirus pandemic or due to lockdown, there is no business. Now I waited for 1 month that things will get normal. Again second month also, third month also, fourth month also, but there was no business. Finally what? I have to shut down because I am not being able to recover my fixed cost, that is my rent. So most of the companies has to shut down their business. Why? Because they are not being able to recover their fixed cost. Because variable cost is going to incur only when there is some or other sort of production. If there is no variable, no production, no variable cost. But boss, fixed cost will remain same. Your meter of fixed cost is running every day, every minute, every second. So the major headache of each and every company is what? To recover their fixed cost. Let's say I have taken a very simple example. This pen I manufactured at a cost of rupees 8. The variable cost of manufacture of this pen is rupees 8. Now suppose if I sell this pen for rupees 10. If I sell this pen for rupees 10, how much I am recovering per pen? Rupees 2 per pen. 1 second. Please switch off the phone. I repeat again, suppose if I am manufacturing this pen at a motto that at least from 2 rupees, 2 rupees, 2 rupees, that I should at least recover 1 lakh. My per pen I am recovering 2 rupees. So for how much pen I have to sell to get rupees 1 lakh? Very simple, 50,000. So once I manufacture and sell 50,000 pen, I am relaxed that at least I am not suffering any sort of loss because my fixed cost is recovered. I repeat again, per pen I am recovering rupees 2. Now my major motto will be that at least I should recover my fixed cost. So suppose my fixed cost is what? 1 lakh. Now, per pen I am getting 2. So once I manufacture and sell 50,000 pen, I will be able to recover rupees 1 lakh. Now my headache is over. That is that I am not suffering any sort of. Really sorry, there was some network issue. So I hope this part is clear. I hope this part was audible. So I have discussed this part. Anyways, I'll be starting the next part, that is the important part. I mean the most important part of the chapter, that is marginal costing equation. So if you guys want to copy, you guys can copy, please. Admin sir, it is working now? Admin sir, it's working now? Okay. So guys, let's start with the important chapter, that is marginal costing. So let's start. Now let's first of all write marginal costing equation. Sales less variable cost. Sales minus variable cost is what? Contribution. Less fixed cost. This is simply the marginal costing equation. Sales minus variable cost, contribution minus fixed cost, that is profit. So once you are thorough with these 5 terms, once you learn to play with these 5 terms, you will be the master of marginal costing. The only thing that is in this chapter is what? These 5 terms. Sales minus variable cost is contribution minus fixed cost is profit. I repeat again, sales minus variable cost is contribution minus fixed cost is profit. So once you are master of this part, I mean once you are thorough with this part, once you know how to play with these 5 elements, you will be the master of marginal costing. Say, so what's the formula for contribution? Very simple. Sales minus variable cost is what? Contribution. Another formula for contribution. Fixed cost plus profit is also contribution. Let's say, suppose my sales is say 200. My variable cost is say 120. My contribution will be 80. My fixed cost is say 40. My profit will be what? Very simple, 40. Now, so what's the formula for contribution? Sales minus variable cost, I have already discussed. So suppose if I want to get 80, my sales is 200 minus variable cost 120, that will be my contribution. Again, 40 plus 40, fixed cost plus profit is also contribution. So n number of formulas can be made with the help of these 5 elements. So I hope this part is clear. Sales minus variable cost is contribution minus fixed cost is profit. Now, the first question what the examiner do ask in exams is PV ratio. That is profit volume ratio. The first question what the examiner do ask is PV ratio, that is profit volume ratio. It is given as contribution divided by sales into 100. So in the given question, suppose my contribution is say 80. My sales is say 200 into 100. So what is PV ratio? Contribution divided by sales into 100. In simple terms, we can say what is PV ratio? The percentage of contribution to sales. In simple words, we can say what is the percentage of contribution to sales? That is what my PV ratio. What is the percentage of my contribution to sales? That is my PV ratio. So in the given case, my contribution is 80, my sales is 200. So I can say my contribution is 40% of sales. Suppose my sales is 10,000. Suppose my sales is 10,000. My contribution is 2,000. So I can say my contribution is 20% of sales. I repeat again, my sales is say 10,000. My contribution is 2,000. So I can say that my contribution is 20% of my sales. So 20% is my PV ratio. Let's take another example. If you guys want to copy this part, you can copy please. Please copy this part. Please copy this part. What is PV ratio? The percentage of contribution to sales. That is how much percent my contribution is of sales. Please copy this part, guys. So let's take few basic question. Let's take few basic question. I have discussed PV ratio. What is PV ratio? The percentage of contribution to sales. Therefore, contribution divided by sales into rent. I have given you guys the equation. Sales less variable cost is what? My contribution minus fixed cost is what? My profit. Now let's take few basic examples. Suppose my sales is 10,000. My contribution is 2,000. So what is my PV ratio? What is my percentage of contribution to sales? Very simple. 2,000 divided by 10,000 into 100. That is what? 20%. Let's take another example. Let's take another example. Suppose my sales is 5 lakh. My variable cost is say 4 lakh. Sorry. 3,50,000. What is my PV ratio? Now I have got my sales 5 lakh. My variable cost is 3,50,000. So what will be my contribution? 1,50,000 is my contribution divided my sales, that is 5 lakh into 100, so 30%. Let's take another example. Suppose my sales is say 3 lakh. Now my percentage of contribution to sales, I repeat again, my percentage of contribution to sales, that is my PV ratio, is say 40%. Now what will be my contribution? I told you what is PV ratio? The percentage of contribution to sales. That is how much percentage my contribution is to sales. So now my contribution is what? How much? 40% of sales. And my sales is what? 3 lakh. So 3 lakh is my sales and my contribution is 40% of sales. Therefore 1,20,000. I hope this part is clear. Let's take few more examples. Now, suppose my sales is say 10 lakh. My variable cost is say 70% of my sales. So what will be my contribution? What will be my contribution? Very simple. I have made two parts of sales. Suppose in the previous question it was 200 was my sales, 120 was my variable cost, 80 was my contribution, 40 was my fixed cost and 40 was my profit. So I have made two distribution of sales where first one is variable cost 120 and 80 was my contribution. Now my percentage of contribution to sales, we call it as PV ratio, is 40%. So what is the percentage of variable cost to sales? 60%. At the initial stage, what we are doing, we are making two breakup of sales, the variable cost and contribution. So if my contribution is 40% of sales, my variable cost will be 60% of sales. So here, my variable cost is 70% of my sales. So what will be my PV ratio? What will be my percentage of contribution to sales? 30%. So I can easily get my contribution as 10 lakh into 30%, that is 3 lakh rupees. Now, one more question. Now suppose my contribution is say 90,000 rupees. My contribution is say 90,000 rupees. And my percentage of contribution to sales is 30%. So what will be my sales? Guys, what will be my sales? Any answers from your end? Answer of this question, guys. Waiting for your answer, guys. My contribution is 90,000 and my percentage of contribution to sales is 30%. I have to calculate a figure whose 30% is 90,000. So what will be that figure? That is the sales. What will be the sales? Any answers? Waiting for your answers, guys. Please post your in the query section. I'm waiting for your answers. I repeat again, my contribution is 90,000. My PV ratio is 30%. That is my percentage of contribution to sales is 30%. So what will be my sales? I have to calculate a figure whose 30% is 90,000. Very good. Vaishnavi, Janvi, Brinda, your answer is incorrect. 56,000 is not the answer, Brinda. Vrinda, please check. Now, as I told you, sales we divide in two parts, variable cost and contribution. Now, variable cost, now PV ratio is 30% of sales. So, my variable cost will be 70%. Now, contribution given is 90,000. So, this 90,000 is equals to 30%. So, how much will be 100%? 90,000 divided by 30%, that is 3 lakh rupees. Or in short, we can say 90,000 is equals to 30. So how much will be 100? Very good, guys. Tanya from Bangalore, the answer is not 30 lakhs, it's 3 lakhs. 3 lakh into 30%, that is 90,000. Another example. Guys, be quick in responding. I'm taking another example. Suppose my variable cost. Suppose my variable cost is say 1,20,000. My percentage of contribution to sales is say 40%. So what will be my sales? Quickly, waiting for your answer, guys. I hope this part is clear to all. Now the next question. Guys, waiting for your answer. Be quick. My variable cost is 1,20,000. My PV ratio is 40%. My contribution is 40% of sales. But in question, the contribution is not given. I have given variable cost. So how much will be my sales? Waiting for your answers, guys. Be quick. I've got answers from Vaishnavi. Very good. Pavitra, very good. Apurva, very good. Aditya. Payal, very good. Poon Kala from Tamil Nadu. Please check your answer. The answer is not 80,000. I repeat again. Here in the question, variable cost is given, that is 1,20,000, and PV ratio is given. Poon Kala, please check your answer. See, as I discussed here, at the initial stage, we make two breakups of sales, that is variable cost and contribution. Now, if the percentage of contribution to sales is 40%, then variable cost will be 60%. Now, in question, is contribution given? No, variable cost is given, that is 1,20,000. So, 1,20,000 is equals to 60%. So, how much will be 100? Very simple, 2 lakhs, simple mathematics. Very good. Hopefully this part is clear. This is nothing but simple mathematics. What we used to call as a cross multiplication or something like that. So I suggest you to copy these questions for your practice, because once you are revising this at the time of exams, these questions will be helpful for you guys. So please copy. Gaurav Jain, very good. Swarupa, very good. Santosh, please check your answer again. Naina Mantri, very good. Poonam, very good. Santosh, please check your answer once again. Please copy this part. Hopefully the PV ratio part is clear now. Let's discuss PV ratio little more. Now, say suppose let's take another example: quantity, per unit price, and amount. Suppose sales is say 500 units at the rate of 10, that is 5,000. Suppose my variable cost is say 500 units into 7, that is 3,500. So my contribution will be 3 and 2. What will be my PV ratio? As discussed, the relationship between contribution and sales we call as PV ratio. What is PV ratio? The percentage of contribution and sales is what? PV ratio. My contribution is 1500. My sales is 5000 into 100. That is. It means what? The percentage of contribution to sales is 30%. We have got the relationship between now we have got the relationship between contribution and sales, and we know it is 30%. Now, suppose if I increase my units to say 600 units, my question, is the PV ratio going to change? Yes or no? My point is, suppose instead of 500 units, if I manufacture and sell 600 units, is the PV ratio going to change? Let's see. 600 into 10, 6,000. 600 into 7, 4,200, 1,800. Therefore, 1,800 into 6,000 divided by 6,000 into 100. No change. Suppose if I manufacture and sell 1 unit also, is the PV ratio going to change? No. 10 into 1, 10. 1 into 7, 7. Contribution will be 3. So 3 divided by 10 into 100. 30%. No change. But let's say, suppose the selling price is changed, say to 9 rupees. Or say variable cost is changed. Is the PV ratio going to change? Yes, it will change. 3 divided by, the contribution 3 divided by 9 into 100, that is 33.3. So my point is, if there is increase in sales quantity or decrease in sales quantity, is the PV ratio going to change? No, not at all. PV ratio remain constant at all the level of sales. But if there is a change in selling price per unit or variable cost per unit, is the PV ratio going to change? Yes. I repeat again, PV ratio remain constant at all the level of sales. Even if the sales is increasing, it will remain same. Even if the sales is decreasing, it will remain same. But if there is a change in selling price per unit or variable cost per unit, the PV ratio is going to change. So major thing is this relationship to be maintained, that is contribution per unit, selling price per unit into 100. Till the time this relationship is maintained, PV ratio will remain unchanged. So what I want to say is, even if the sales quantity is increasing or decreasing, PV ratio will remain constant. But if there is any change in selling price per unit or variable cost per unit, the contribution, the PV ratio is going to change. I hope this part is clear. So, let's write the conclusion. PV ratio remain constant at all the level of sales. If question is silent, So if the question is silent, what we will assume? That PV ratio remain constant at all the level of sales. The relationship between contribution will never change. But yes, however, if there is any change in selling price per unit or variable cost per unit, then PV ratio will So I repeat again, very simple. If the question is silent, what you have to assume? That PV ratio is constant at all the level of sales. I repeat again, if the question is silent, what you have to assume? That PV ratio remain constant at all the level of sales. However, if the question clearly states that there is change in selling price per unit or variable cost per unit, yes, the PV ratio is going to change. Hopefully this part is clear now. So we can say these are the assumptions of marginal costing, that selling price per unit remain constant, variable cost per unit remain constant. I repeat again, what are the assumptions of marginal costing? I am writing these assumptions here. Assumptions. If the question is silent, what you have to assume? Second, and if selling price per unit is constant, variable cost per unit is constant, then yes, PV ratio will remain unchanged. So I repeat again, what is the basic conclusion of this discussion is that first point, if the question is silent, PV ratio remain constant at all the level of sales. However, if the question clearly states that there is change in selling price per unit or variable cost per unit, yes, the PV ratio is going to. I hope enough with PV ratio now. So please copy, guys. Mansha, see, suppose if the price of raw material increases and it is given in question that the raw material rate per unit increased by 10%, Yes, the variable cost per unit is going to change. But in normal scenarios, the variable cost per unit will always remain constant. But if the question clearly says that there is inflation in the cost of raw material and the raw material price per unit is inflated by 10%, then yes, the variable cost will change. But in maximum cases, the variable cost per unit will always remain same. Variable cost per unit will always remain same. Please copy each and every part, guys. It will be very helpful for you when you are revising the chapter. So please copy. We are done with the first part of the chapter, that is PV ratio. We'll be moving towards the next part. So I suggest you to please copy this part. Please copy each and every word, guys. Very, very important. Once you are revising this chapter, this will be very helpful for you. Mansha, hopefully your doubt is clear. Mansha, hopefully your doubt is clear. Variable cost per unit, selling price per unit never changes if the question is silent. So, done with PV ratio. What is PV ratio? Percentage of contribution to sales. Now, let's proceed further. Now, see, the next question what the examiner do ask is what? Break even sales. What is break even sales? You guys must have studied in economics also, and I have also discussed in the initial part of the session. What is break even sales? that level of sales where there is no profit, no loss. What is break-even sales? That level of sales where there is no profit, no loss. Or we can say that level of sales where the sales is equals to total cost. When the sales is equals to total cost, yes, the profit or loss will be zero. So that level of sales where there is no profit or no loss, we can say profit or loss is zero. That level of sales is basically the break-even sales. Now, let's discuss this with the help of an example. Suppose my sales is say 200. The same example I am taking throughout the chapter. My variable cost is say 120. Therefore, my contribution will be 80 rupees. Suppose my fixed cost is 40 rupees. Therefore, my profit will be how much? The relationship between contribution and sales we call as PV ratio. That is 80 divided by 200. That is 40%. Hopefully this part is clear till now. Very good, guys. Now, my point. Suppose this is the scenario. Now I want to calculate break-even sales. Again I repeat, I want to calculate break-even sales. That is that level of sales where there is no profit, no loss. There is no profit, no loss. Or we can say sales should be equal to total cost. I repeat again, I have to calculate break-even sales. That is that level of sales where there is no profit, no loss. Or we can say the level of sales where total cost and sales are equal. The relationship between contribution and sales I know is 40% and it never changes. This relationship will remain same as I discussed previously, that this relationship remain constant at all the level of sales unless and until the question clearly specifies the same. Now, I have to calculate break-even sales. Now, many students say that, sir, you are telling na that the level of sales where there is sales is equals to total cost. So, suppose my variable cost is 120, my fixed cost is 40. So, our total cost is 160 and that will be your break-even sales. Many students do like that. Let's say whether their claim is justified or not. Suppose, I repeat again, how come they derive to 160? That is variable cost is 120, sir. 40 is my fixed cost. Therefore, my break-even sales is 160. So, you told na, ki sir, break-even sales is that level of sales where their sales is equals to total cost. So, my total cost is 160 and it is break-even sales. The answer is wrong. How come? Say, suppose if I calculate as 160. Now, since the sales is reducing, the variable cost will also reduce, because as I told you, this relationship always remains same if the question is silent. So it will be 64 and the fixed cost as discussed is always constant at all the level of sales, therefore 24, and this answer is completely, because we want how much? Zero as profit or loss. 160 into 40%, 64 minus 40 is my fixed cost, 24 is my profit. So this answer is wrong because this is not break-even sales. Now how to calculate break-even sales? Very simple. As I discussed that at break-even sales your profit and loss is what? Zero. At break-even sales, my profit and loss is what? 0. Now my fixed cost will remain constant at all the level of sales. So 40 will be my fixed cost. This minus 40 should be 0. Very simple. 40. 40 minus 40 should be 0. Now this contribution is equals to how much? 40%. 40 is equals to 40%. How much will be 100%? The variable cost will be. I hope this part is clear. I repeat again. As I told you guys that at break-even sales, my profit and loss is what? 0. My fixed costs remain constant at all the level of sales. So suppose my fixed cost is 40. So here in case also my fixed cost will be 40. Now this 40 minus 40 should be 0. Very simple. Now this contribution and sales relationship always remain constant. That is 40%. If the sales is 100, contribution will be 40. So this 40 is equals to 40%. So how much will be 100%? So my final answer is 100 is my break-even sale. Now there is a formula given in the book. What they have done, what actually I have done. This 40 divided by 40% I did. This 40. This 40 divided by 40% is done. Now how come we derived this 40? 40 plus 0 divided by 40%. 40 plus 0 divided by 40%. This 40 is what? My fixed cost. 0 has no value, divided by PV ratio, that is 40%. So this is how the formula is derived in the book, that is break-even sales in rupees is fixed cost divided by PV ratio. I hope this part is clear, guys. Again, as I told you in all my sessions, that there is no formula in cost accounting. Each and every formula has some or other concepts behind it. Each and every formula has some or other concepts behind it. So I hope this part is clear. You guys are thorough with the concept. Now question arises, how to solve in exam? Simply write this part. Write down the formula and calculate the answer. This whole exercise has been done to make you guys understand that how these formulas are prepared. Hopefully this part is clear. So how come this formula is derived? Hopefully this part is clear. I suggest you guys to copy this part. Just try to learn the concepts. Just try to understand the concept rather than mugging up the formulas. That's why I have made all this exercise. Hopefully this part is clear, guys. So how this formula is derived? With the help of all these exercises. So please copy this part. But again I repeat, in exams, what do you guys have to do? Simply write this part, write down the formula and the solution. This whole exercise has been done to make you guys understand the concept, the logic behind the formula, guys. Now, let's discuss break-even sales with the help of one more example. $500 into 10, 5,000. Variable cost 500 into 7, 3,500. My contribution will be what? 1,500. My contribution per unit is 3. My fixed cost, let's say 900. Therefore, my profit will be 600. As discussed, the relationship between contribution and sales is what? PV ratio. We have already discussed the relationship between contribution and sales is what? We call as PV ratio. And it is what? 1,500 divided by 5,000 into 100, that is 30%. It means what? Our contribution is 30% of sales. Alternatively, you can also say that 3 divided by 10 into 100 is also. Now, the same concept. In this scenario, you have to calculate break-even sales. So, how to calculate without formula? Very simple, the same concept. At break-even sales, we want profit as 0. As discussed, the. Yes, sir. One second, sir. सर इधर तो बराबर आ रहा है. No problem, sir. Discussed what is PV ratio? The relationship between contribution and sales, we call it as PV ratio. This is 30%. 1,500 divided by 5,000 into 100, 30%. Or 3 divided by 10 into 100, 30%. Now, in this scenario, we have to calculate what? Break-even sales. So very simple, as discussed previously. At break-even sales, my profit or loss should be 0. The fixed cost 900 will remain constant at all the level of sales. This minus this should be 0. So this figure will be 900. Now this 900 is equals to 30%. So how much will be 100%? Very simple. 3,000. So again we have used the same concept, that is fixed cost divided by PV ratio, that is 900 divided by 30%, that is 3,000 rupees. This is my break-even sales. Break-even sales in rupees. Now see, my break-even sales is 3,000 rupees and 1 unit is sold at the rate of rupees 10. So I have sold how many units? 300 units. I repeat again, My break-even sales is 3,000 rupees, and one unit is sold at a cost of rupees at a price of rupees 10. So in aggregate, how many units I have sold? Very simple, only 300 units. Alternatively, we can calculate the units as follows. The same example I have discussed initially. Suppose this pen is manufactured at the rate of rupees 7 and sold at the rate of 10. How much I am recovering per pen? How much I am recovering per pen? 3 rupees. Now first target will be what? 3 rupees, 3 rupees, 3 rupees, 3 rupees, so that I am able to recover in aggregate how much? 900. So per pen I am recovering how much rupees? 3 rupees, and in aggregate I have to recover how many rupees? 900. So 300 pens are to be sold. So how can we make the formula? 900 is what? My fixed cost divided by 3 is what? My contribution per unit. We call it as break even sales in units. So these two formulas I have discussed, fixed cost divided by PV ratio. I hope now you guys are aware that how this formula is prepared. So break even sales in rupees, fixed cost divided by PV ratio, and break even sales in units, fixed cost divided by contribution per unit. Why come this? I repeat again, this pen is manufactured at a cost of 7 rupees, sold for 10 rupees. So how much I am recovering per pen? 3 rupees. Now my first target is what? To recover my fixed cost. My fixed cost is 900. So if I am recovering 3 rupees per pen, and in aggregate I have to recover how much? 900 rupees. So how much pen I have to sell? Very simple. 300 pens. Hopefully this part is clear now, guys. I suggest you to please copy this part. Break even sales in rupees, the formula is fixed cost divided by PV ratio, and break even sales in units, fixed cost divided by contribution per unit. Please copy this part, guys. Very good, Sakshi. Please copy this part. So we are done with break even sales. If you calculate it in rupees, fixed cost divided by PV ratio. How this formula is derived, I have already discussed. In units, I hope you guys are aware about the concepts now. No need to learn the formulas. Just try to remember the concepts. It's more than sufficient, guys. So now moving towards the next part of the chapter, the third part, what examiner generally do ask is what? Desired sales. Now, let's discuss desired sales in the same way we have discussed break-even sales. Suppose my sales is 200. Yes, sir. हाँ जी sir. Let's start desired sales now, guys. The sales is 200. My variable cost is 120. My contribution will be 80. My fixed cost is 40. My profit is. The relationship between contribution and sales we have already discussed is called as PV ratio. It is 80 divided by 200 into 100. That is 40%. Hopefully this part is clear. Now suppose on a fine morning I wake up and say I want to earn a profit of say 600 rupees. How much sale I have to make? How much, I mean, what should be my sales to earn a profit of 600 rupees? Suppose my desired profit is say 600 rupees. Now what should be my sales? What should be my desired sales? I hope every one of you can calculate with the logic I have discussed in break-even sales. In break-even sales, I told you that we were expecting a profit of 0. But here I am expecting a profit of 600. Very simple. Fixed cost, as discussed, will remain unchanged. So this value minus 40 should be 600. 640 minus 40 should be 600. This 640 is equals to 40%. So how much will be 100%? 1600. Hopefully it is clear now. Just like break-even sales, in break-even sales we were expecting a profit of 0. But in this case, we are expecting a profit of 600. So, what I have done to calculate 600? 600 plus 40 divided by 40%. That's what I did. First of all, I calculated 640 divided by 40%. How come 640? 600 plus 40 divided by 40%. Therefore, the formula will be 40 is my fixed cost, 600 is my desired profit, 40% is my PV ratio. So, that is what? My desired sales in rupees. So 40 plus 600 divided by 40%, that is 1600. Very good, Payal. Very good, Satish. Sakshi, very good. Copy this part. Please copy this part. It will be very helpful for you. That's why I'm giving you enough of time to copy this part. Please copy. Mr. Rakesh Vyas, this is my question. I have not taken any sort of, I have not taken any sort of calculation. In the question it is given my sales is 200. It is given in question. I have started this part initially in this question. Sales is given as 200. My variable cost given is 120 and my fixed cost given is 40. So this is the data given in question, Rakesh. Rakesh Vyas from Jodhpur, hopefully your doubt is clear. This data is given in the question. I have not made any sort of calculation. No, Pooja. See, this is not the contribution. This is the calculated contribution. And how this calculated contribution is derived? With the help of fixed cost plus profit. So we cannot take as contribution divided by PV ratio because it's not the contribution as given in the question. It is the calculated contribution depending upon the figures. So hope you guys have copied this part. Mansha, fixed cost is absorbed on the basis of normal capacity. I'll be discussing this part in the next session of budgetary control also. So fixed cost is absorbed on the basis of normal capacity. Now let's take another example, guys. The same example I have discussed in break-even sales, quantity, price and amount. Suppose sales is 500 into 10, 5,000. Variable cost 500 into 7, 3,500. My contribution is 3 and 1,500. Suppose the fixed cost as given in question is say 900. Therefore, my profit will be what? 600. The relationship between contribution and sales we call as PV ratio. That is what? 1,500 divided by 5,000 into 100. That is 30%. So again, on a fine morning, I thought that I'm getting only a profit of 600. What if I want to earn a profit of say 3,000 rupees? Suppose my desired profit given is 3,000 rupees. So what should be my desired sales? Very simple. How much profit I'm asking for? 3,000. The fixed cost will remain same, 900. This figure will be 3,900. It is equals to 30%. So how much will be 100%? 13,000 rupees. Same concept, the same logic I have used in break-even sales. So again, what I have done, desired sales in rupees, that is fixed cost, plus desired profit divided by PV ratio. My fixed cost was 900 plus 3,000 divided by 30%. That is 3,000 rupees. 1 unit is sold for rupees 10. So we can say 1,300 units. Again, we can calculate the units in some other way also. How come? Suppose this pen is manufactured at a cost of 7 rupees and sold for 10 rupees. How much I am recovering per pen? 3 rupees. Now in break-even sales, we want to simply recover 900. That is my fixed cost. In break-even sales, we want to recover only 900 so that I can get my break-even sales. That is 900 divided by 3 you have done is 300 units. Now here in the given case, over and above 900, I want to recover 3000 more. I want to recover 900 also, and apart from 900, I want to recover 3000 more. So in aggregate, I want to recover how much? 3900. 900 for my fixed cost and 3000 for my profit. So in aggregate, I want to recover 3900. And per pen, I am recovering how much? 3 rupees per pen. So 3. In aggregate, I have to recover 3900 rupees. So how much pen I have to sell? Very simple, 1300 pen. So fixed cost plus desired profit divided by contribution per unit. How come this formula is derived? I have already explained you guys. 1300. Please copy this part. Desired sales in rupees and in units. Very good, Naina. Very good, Sanjay. Mansha, I'll be discussing the concept of shutdown cost and everything in the coming part of this session. So be patient, guys. Krish, these questions are from past examinations, and the old practice manual as issued by ICAI. So you guys can refer after solving the question. I mean, I suggest you to check the answers. Once you are done with the solution part, you can check the answer from the old practice manual. Please copy this part, guys. Now, PV ratio is done, that is contribution divided by sales into 100. Break-even sales is done, that is fixed cost divided by PV ratio and fixed cost divided by contribution per unit. We are done with desired sales also, that is fixed cost plus desired profit divided by PV ratio and fixed cost plus desired profit divided by contribution per unit. Now moving towards the next part of the chapter, that is margin of safety. What is margin of safety? In simple, we can say safety margin, or we can say how much we are safe from deadline of business. Suppose this is the deadline. Suppose this is the deadline and I am standing here. Suppose the deadline is say 3000 sales and I am standing at 5000 sales. Once I cross this deadline, I'll fall down. So how much I am safe? 2000. I repeat again, this is the deadline, that is 3000 sales and I am standing at a sales of 5000. So how much safe I am from deadline? Very simple, 2000. This deadline is what? My break-even sale. What is my deadline basically? Sureka, sir, illustration we have to do on our own. Sureka, first of all, please understand, please listen what I am discussing. I'll be solving these illustrations also, so be patient and listen what I am saying and understand what I am discussing. So, margin of safety, safety margin, it means what? How much we are safe from deadline of business. That is, suppose my deadline is say 3000 sales and I am at a sales of 5000. So how much I am safe? 2000. Deadlines means what? Break even sales. So suppose I am standing at a sales of 5000. This is my actual sales. My deadline is what? My break even sales. This is how come I will derive margin of safety. So what is margin of safety sales? Very simple. Actual sales minus break-even sales. So herein, actual sales is also divided in two parts. First one is break-even sales and second one is margin of safety sales. Say, suppose break-even sales is say 70% of the total sales. So what will be the percentage of margin of safety? 30% of that. Suppose if it is 60% of the total sales, it will be what? 40% of that. Please copy this part. I will be discussing more on margin of safety. Please copy this part. Now, as I told you that every business first want to achieve break-even sales. I repeat again, every business first want to achieve break-even sales. That is, they want to recover their fixed cost first. Now, after recovering fixed cost, after you recover fixed cost, the extra contribution we earn is altogether what we call as profit. Once you recover fixed cost, see, I repeat again, sales minus variable cost is contribution. My first target is to earn that much of contribution that I can recover my fixed cost. Suppose my contribution is say 10,000 and it is 40% of sales. Now, once I recover 6,000 is my say fixed cost. So once I recover fixed cost, that is I achieve my break-even sales, the extra contribution over and above fixed cost that is profit will be 4,000. Now, if I want to calculate break-even sales, simply I want to earn a contribution of say 6,000. My break-even sales will be suppose to earn extra profit over and above break-even sales. That is over and above the fixed cost. If I want to earn extra, we call it as profit. This is what the extra contribution, and it is also equals to 40%. So 10,000. This is also my margin of safety. So we can calculate margin of safety in two parts. First part is two ways. First way is what? Actual sales minus break-even sales. That is what? Margin of safety. Second way we can calculate margin of safety as profit divided by I hope this part is clear. Sakshi, standard costing is also easy, marginal costing is also easy. It's more about practice rather than anything else. I hope this part is clear. Margin of safety, I suggest you guys to please copy this part. If you have any doubts in PV ratio, break-even sales, margin of safety sales, desired sales, you guys can raise query. Thank you, Payal. Any doubts, guys? I'm waiting for your queries. See, there is a query raised by Jyoti from Hyderabad that, sir, what is the difference between margin of safety and profit? Margin of safety is the sales. I repeat again, margin of safety is the sales. And the contribution we get from margin of safety sales is profit. The contribution we get from break-even sales is what? The fixed cost amount. Sakshi Gupta, I'll be solving your query in the next session. I'll be discussing a few questions on shutdown point also. We'll surely address your query. I hope you guys have copied. I'll be explaining that profit divided by PV ratio concept once again because few of the students has raised query. So I'll be explaining it again. So hopefully this part is copied now. Suppose my sales is say 5,000. My variable cost is say 3,000. My contribution is say 2,000. My fixed cost is say 1,200. My profit is say 800. Now, my relationship between contribution and sales, we call it as PV ratio. Yes, 40%. Now, suppose if I want to calculate break-even sales, the break-even sales is 3,000. I've calculated it directly. 3,000 my contribution, my variable cost is how much? 1,200. Now, in this break-even sales, I have already recovered my fixed cost. My fixed cost is already recovered. My fixed cost is already recovered at a sale of rupees. Now my extra sales above break-even sales, that is my margin of safety sales, is 2,000. 2,000 into 40%, 800. My fixed cost is already recovered. I am writing it again. Already recovered. So 800 is my profit. So now I have my profit is 800. My contribution will also remain same because fixed cost is already recovered. Then this 800 is equals to 40%. So how much will be my 100%? That is, I have calculated this. So the extra contribution over and above fixed cost, that is called as profit, divided by PV ratio, is my margin of safety. Mansha, once you cross break-even point, see here my break-even point is crossed. The contribution I am recovering is 800. Since I have recovered my fixed cost, now I will start earning profit. Break even sales 3,000, 2,000 is my margin of safety, 5,000 is my total sale. Hopefully this part is clear now. Chavda Payal Sanjay from Dule. Sir, if in break even sales in exam it is not given to calculate in units or in rupees, then what to do? Calculate it in both the way. Don't give examiner any opportunity to deduct your marks. Go on the safer side. Go with the safest approach. Now see guys, hopefully each and every part is clear till that, whatever I have discussed till now. Let's take a quick review what I have discussed. If you guys want to copy this part also, you guys can copy. I have discussed PV ratio, that is contribution divided by sales in 200. I have discussed break even sales in units, it is fixed cost, sorry, in rupees first, it is fixed cost divided by PV ratio. In units, it is fixed cost divided by contribution per unit. Third, I have explained desired sales. Fixed cost. In units, fixed cost plus desired profit So these are all the concepts I have discussed till now. Sakshi, be patient. I'll be addressing all your queries. Don't worry, Sakshi. So these are all the concepts I have discussed till now. Hopefully everything is conceptually clear. Why this formula, how these formulas are prepared. Now, the most important part, it's the time for you guys to pay back. I want you guys to solve illustration number 1 from my material and write the answers in your query section. I'm waiting for your answers. I repeat again, it's the time for you guys to pay back. This is the part what I have discussed till now. Now it's the time to pay back, guys. So I want you guys to solve illustration number 1. For the student who has not downloaded the study material, my question number 1 is sales 1 lakh, variable cost 70,000, fixed cost 18,000, find PV ratio, break-even sales, margin of safety. Please write your answers in the query section. I'm waiting for your answers, guys. Be quick. I'm waiting for your guys. I'm waiting for your answer, guys. My sales is 1 lakh. My variable cost is 70,000. My fixed cost is 18,000. Find PV ratio, break even sales, and margin of safety. Waiting for your answer, guys. Please solve. I'm waiting for your answer. Quick. The question is very easy. I've already discussed all these concepts, so waiting for your answer. Mr. Satish and Gopi, hopefully your doubt is clear in relation to margin of safety. Janvi and Ayushi, write all the three answers, that is PV ratio, break even sales, and margin of safety. All the three answers together, Janvi and Ayushi. Your PV ratio is correct. All of you, please solve and write the answers. Very good, everyone. Mansha, Sanjay, Vaishnavi, Pavitra, Sam, Aditya Gupta. Very good. All the answers are correct. I am discussing the presentation also. How to present it in exams. Very good everyone, very good everyone. Now, hopefully this is the way you guys have to present the solution. Now, solve question number 2 of my study material I have provided. I repeat again, solve question number 2. First question, everyone has answered it correctly. This is the way you guys have to present the solution. I request you guys to solve question number 2 of my study material. Please. This is question number 2 for your reference. Very good, Saket Das. Very good, Sanjay. The last part, that is little tough. The D point is little tough. So apply your brains and try to solve it. First, second and third are very easy. But yes, the last part, that is calculate the number of units to be sold to earn a profit of 10% on sales. You have to do a bit of exercise. Everyone, I'm waiting for your answers. Who is the first person? Who is going to be the first student to solve the last part? I am waiting for your answer of the last part. That is the number of units to be sold to earn a profit of 10% on sales. So who is going to be the first student to solve the solution? I am waiting for your answer, guys. Still waiting for the last part answer. This part. Vaishnavi Jamwal, your answer is correct for the last part. Very good. Very good, Vaishnavi. The last part is solved by Vaishnavi and your answer is correct, Vaishnavi. Very good. Saket Das has also solved the last part and the answer is correct, Saket. Very good. Very good, Saket, and very good, Vaishnavi. Sam from Kerala has also solved the last part. Very good, Sam. Still waiting for you guys to solve the last part. Yes, Saket. Yes, Saket, your answer is correct. Apurva, last part answer is incorrect. Aditya Gupta, again the last part answer is incorrect. Please do it again. Till we have 15 minutes for exercise. So, still waiting for the last part answer, guys. Sakshi Gupta, still waiting for your answer. Vrinda S. Ved. Surekha, where are you guys? Waiting for your answer. Apurva, your answer is incorrect. Please check once again. Ankush Nagpal, your answer is correct. Aditya Gupta, you have to try it again. The answer is incorrect. Mansha, still your answer is not correct. Mansha, your answer is incorrect. The last part is very interesting and important. Sanjay, incorrect answer. I'm discussing the last part now. Now, selling price is given 20, variable cost per unit is 14, fixed cost is 7,92,000. Calculate the number of units to be sold to earn a profit of 10% on sales. So let units sold be X. So my sales will be 20X. My variable cost will be 14X. My contribution will be 6x. My fixed cost is given, that is 7,92,000. They are saying that the profit is to be 10% of sales. 10% of 20x. Therefore, 2x. So 6x minus 792 should be 2x. X will be 1,98,000 units. The last question was calculate the number of units to be sold to earn a profit 10% on sales. Hopefully this part is clear now. Everyone, if you guys want to copy this solution, you guys can copy. Satish, please check your answer. The answer is 1,98,000 units. I hope the question number second is done. Moving towards the next question, I request you guys to please write the solution of illustration number 3. Waiting for your solution, guys. Solve illustration number 3. My break-even sales is 2,70,000. My fixed cost is 90,000. What will be my PV ratio? Waiting for your answers, guys. Quick, guys. Waiting for the last answer. Aditya Gupta, Sam, Vaishnavi, Saiket, Varsha, Sanjay, everyone, very good. Your answer is correct, 33.33%. Very good, guys. Everyone, very good, guys. Your answer is correct. Hopefully, everyone has solved question number 3. The solution is here. Now, guys, I'm expecting answer of question number 4. So, please start solving question number 4. Vandana Singh, it is 33.33%, not 3.3. Aditya, answer number, question number 4 solution is correct. Very good. Aditya Gupta has solved question number 4. Sam, your answer is correct. Vaishnavi, your answer is correct. Aditya Gupta, your answer is correct. Lena Mantri, question number 2. Answers are correct. Dexina Tommy, your answer for question number 3 is correct. Please solve question number 4. Aditya Gupta from Varanasi, your answer is correct. Sanjay, incorrect answer. Please check once again. Illustration number 4, your answer is incorrect, Sanjay. Pavitra from Kerala, your answer is correct. Sanjay from Noida, please check your answer, dear. Still waiting for answers from few students. Sakshi Gupta, Ayushi, Apurva, Vandana Singh, Saket Das, still your answer. Ankush Nagpal, your answer is correct. Jyoti, your answer is correct. Question, please check your answer. It is not 42 lakh. Please check your answer, question. Ankush Nagpal, your answer is incorrect. Please check. Chawda, Payal, Sanjay, please check. I have already written the solution. Please check. Arjun, check the solution. I have written already solved the question over the board. Please check your solution. The fixed cost is 90,000. My PV ratio is 30%. My margin of safety is 40%. So now first calculate break-even sales, that is 90,000 divided by 30%, that is fixed cost divided by PV ratio. that is 3 lakh rupees. Now, as discussed, actual sales can be divided in two parts: break-even sales and margin of safety sales. Here, margin of safety sales is given as 40%. Therefore, the break-even sales will be 60%. And we have got break-even sales as 3 lakh. So, 3 lakh is equals to 60%. So, how much will be 100%? 5 lakh will be the total sales. Arjun, please check it again. Very good, Mansha. Now, since we have got the sales, we can easily calculate profit also. My sales is what? How much? 5 lakh rupees. The relationship between sales and contribution is PV ratio. And contribution, it is 30%. It means what? Contribution is 30% of sales. That is 1,50,000. Balance will be the variable cost. Fixed cost already I have 90,000. So my profit will be 60,000. Very good, Satish. Takit Das, it is not that tricky, but yes, very good for your efforts. Hopefully everyone has got the answer. Very good. Question, it is not 6 lakh. Profit is only 60,000. Hopefully everyone has solved the questions now. So guys, we have discussed the basic part of marginal costing, that is the PV ratio, break-even sales, desired sales, margin of safety. We have discussed few questions. In fact, you guys have solved all the questions. Thanks for your efforts. So let's wind up the session for today. I suggest you guys to solve few questions of study material. We'll be discussing some advanced questions of this chapter tomorrow. And apart from this, I suggest you guys to please solve few questions of study materials. You guys can raise the query. Whatever you find, difficulties in the question, you can raise the queries in the next session. I'll try to address all your queries in the next session relating to the questions you guys have solved. So till then, thanks for your active participation in the session. Thank you very much, guys. Hope you guys are clear with the concepts, how these formulas are derived. So practice hard. Practice is the only solution.
Mr. Bipin.
Thank you very much, guys. Yes, sir.
You can specify.
Suggested by sir, I'll be specifying few question number. So please note down the question number of study material. Just give me a second. I request you guys to solve illustration number 3, illustration number 5, illustration number 6, Illustration number 8. Illustration number 9. Illustration number 10. That's it. And apart from this, I have provided that additional question for practice. There are somewhat 8 to 9 questions. So I want you guys to solve these questions on your own. I'll be discussing all your queries in the next session of marginal costing. So the questions as suggested from the study material. Apart from this, I have provided few questions, additional questions for practice. So the material has already been provided. So I suggest you to solve all these questions, and I'll be addressing all your queries in relation to these questions in the next session. Okay, friends. So let's wind up the session. Take care, work hard, study hard, and practice. Thank you very much, guys.